Hey everybody, this is Chris Miles, and that was just about scared me how I said that. Hey, it's Chris Miles, cash flow expert and anti-financial advisor. Hey guys, I want to share something because I'm kind of ticked off right now, and I just want to share this, not to make you depressed or anything like that, but even though I've been, semi-retired myself, right? I've been able to be out of the rat race where I don't have to work and do those kind of things, and so I'm able to retire. But now I've come back out of retirement primarily because I keep seeing stuff like this over and over, and it drives me nuts because I know that it costs you thousands, tens of thousands, and even hundreds of thousands or millions of dollars. And this is on a tiny scale. I had a client just recently where same thing happened with them, but it was a $2 million difference in 20 years. I'm going to show you something really tiny because I want you just to see how magnificently bigger this is. I'm coming up with words out of my mouth, obviously, um, because I had a client that said, "Hey, I've got my kids. I set up a plan with them with a company I actually use." And this guy that's doing these policies, he's definitely not no small beans. He's actually a pretty good infinite banker, right? But again, like what I do is Max ROI Infinite Banking. And I want to show you that it's not just about having a lower death benefit or anything. In fact, in truth, you actually can have both more cash and a bigger death benefit if you design these right. And seriously, the only reason that this was designed this way is my guess is that because it was such a low premium, the guy wanted to make more money to make it worth his time. But that's beyond the point because again, it's got to be about you and what helps you best. So I'm going to share my screen to show you what I'm looking at here, right? Let's see. All right, here we go. Now, this one right here, this is the example that was sent. So this is with the company I use, Penn Mutual. I use several different companies, but this one definitely is great for creating biggest bang for your buck, right? Again, that max ROI. So I use this majority of the time, use this company. Now he's showing you here, this is an in-force illustration. So he already set this policy up almost a year ago. But by this point now, it's actually about where it's hitting that 1 year cash value, which you see here is going to be about 1178, about right about now. So now you see the death benefits about 264,000, right? Which is great. That's fine. But here's the thing, and I think he front loaded this a little bit to make it higher. But notice he's putting in 778 per year on his son. This is a 7-year-old son he's doing it for. So this is becoming kind of like his own, like college savings slash whatever he wants it to be. Just a savings for his child. And he did it for all 3 kids. Now you'll see that they run this out forever, right? Like this goes out till basically 100, and voila, they almost get to $1 million by age 100. Now here's the thing that ticks me off, right? Because I've seen how this is designed. Like I know how to do this better. So I actually told him, I said, when I was sending that, like when I was crafting the email before I ran the numbers, I said, you may not want to mess with this at all. It's probably going to be close. Well, I had to delete some of this because when I ran it, I said, okay, let's take that 1178. I'm not encouraging him to really try to cancel to go with the same company again. Like that's the thing we're in discussion with, but watch this, right? So 1178. So he's already paid a big chunk. Like the majority of your fees come out in that first year, and in fact, about half went here. So I'm guessing he probably put in over $2,000 to begin with in the first place. So I said, all right, let's just presume we do it again. So you have to go through that same period. But again, I minimize those costs as much as we can. So really, my year one is going to be their year two. So this 1403 is what you have after 2 years, right? So I'm going to, my year one is going to have the money from year one plus putting in money starting over again. Watch this. Year one, 1614. Now remember, even with this policy where he's already paid more of the costs, look, 1400 versus mine already in year one, 1614. Day one, he's already got more cash in his policy than that. Now here's the one place he doesn't have more. Notice the death benefit is 154,000 versus 264,000. So it's about $100,000 less death benefit. But watch this. Notice that his death benefit stays about $250,000 for really at least 25 plus years, right? Mine ends up hitting $250,000, roughly about, where there it is. Yeah, right there, 254,000, about 19 years in. So it does steadily creep up. But notice, year 5, I've got $4,600. Now their year 6 would be the same thing for them, 4165. We already have $500 more by year 5, right? 5 years in. Year 10 for mine, 10,000, just over $10,000. So already he's got way more than he's put in, right? Um, for them, that's year 11, $9,300. Now look at this. So like, year 21 for them, 22,000. For me, that same year 20, 26,000, almost 27,000. Now guys, this is assuming the same dividends. This is not like a little peeing contest between companies. This is the same exact company, just designed differently with better cost structures, right? 40,000 by year 25. Flash forward here. Let's go all the way to the age 60 here, right? So age 60 showing $250,000 even. By the way, the death benefit's $580,000. So $250,000 of cash value. Now that's year 61 for him, or age 61 here. So age 61 for him shows about 180,000. 250, right? Like I just said before, 250 right there versus just under 180,000. Even by, even to get ridiculous here, right? Even by what is it, year 60 here with them, 245,000 with them. That's year, what was that, 59, 349. It's just ridiculous. I even stopped at age 65. I didn't put any more in. So I stopped at 330,000, even though it keeps growing from there on, right? 330,000 age 65. For them, that's year 59, 230,000. That's a $100,000 difference there in just what, in those many years, right? Now the crazy thing is I've actually dropped it down the minimum $329 a year. So for those last 5 years, so really age 60 was like the last time we were apples to apples. And then I just dropped it off. And even though I'm putting in less, it still kicks the crap out of it. And by the way, look, it's got a $659,000 death benefit, where here, same place, 422,000. So I had more death benefit, more cash value, more leverage, more everything. Main difference was just design. It was just how you design the costs. And that's my point, guys. It's not about dividends and all that kind of crap. Like that's just smoke screen. I have companies that pay 1% dividends that can be companies paying 6% dividends. But here's the key. It's all about designing the costs. How can you lower those costs as much as you possibly can while keeping it tax-free, while keeping within those limits? That is the difference, guys. And this is just, over $700 a year, right, on theirs versus mine. Like it's just, ridiculous. By the way, look, he put in 44,000 to have $330,000. Now that's over 50 years. Granted, that's a long period of time, but it doesn't matter. The fact is that imagine what that's like if this is just thousands of dollars, right? What if it's just thousands? What if this is like, you're talking about putting in 10,000, 20, 50, 100,000 a year? Don't you think this is going to make a difference? Yeah, huge difference. So guys, that's why I'm ticked off. I'm ticked off because this should not be happening. Granted, this is good. This is the typical infinite banking policies that you're seeing out there. This is why I tell people like infinite banking is not the answer, right? And by the way, the best way to use this is to invest outside of the policy, to do other things like buying real assets like real estate and those kind of things to generate more cash flow. Then this thing becomes an amazing plan. By itself, it's great. It's good. But it can always be better. And of course, if you can lower the cost, maximize the return, get it a max ROI infinite banking policy like what I'm designing here, that's where it makes all the difference. So guys, just wanted to show you that because, man, I was just fired up. It's such a tiny policy, but look at the massive difference. That was a $100,000 difference from putting in the same amount of money. Guys, that should not happen to you. That's my challenge to you, is that this has got to stop. Anyways, just wanted to share that with you guys. You can always, if you have questions, you can always go check out moneyripples.com, contact us through there. So anyways, make it a great day. We'll see you later.